Introduction to Business Organizations. Have you ever wondered what is the purpose of a business? Peter Drucker, an eminent management thinker, has argued that the purpose of business is to create and keep a customer. Drucker defined the purpose of a business in this way in 1967, at a time when most businesses did not adopt this strong customer focus. His view, therefore, represented a radical change to the accepted view of what businesses do. Almost 50 years later, however, this approach has become part of the conventional wisdom. It is now widely recognized that in order to succeed, businesses must focus on satisfying the needs of the customer, and that this is the difficult part, keeping the customer. Although the customer has always provided the main source of revenue for a business, this has often been taken for granted. In the past, too many businesses assumed that the customer would readily accept whatever services or products were on offer. When competition was weak and customers were passive, businesses could operate under this assumption and still make a profit. That's why competition among sellers of products and services is important because it gives customers greater choice and therefore increases the customer's bargaining power as they can be more assertive. They now demand higher quality services and goods at cheaper prices. They also require that services and goods be delivered faster with an increasing emphasis on the product being tailored to their individual needs. If a business cannot meet these needs, a competitor often can. Thus, the business mantra for the current era is the customer is king. Perhaps, in the Philippines, the mantra is the customer is always right. And this also is a way to keep the customers. Most businesses now recognize this fact and organize themselves accordingly. In general, businesses are formed when an investor puts up a capital and seek license to operate a business. An investor could be one or more persons, and by persons, it could also mean a juridical person. Businesses in the Philippines can be organized in various legal structures, each with its own set of requirements, benefits, and limitations. The most common forms of business organization in the Philippines include the following: sole proprietorship. This is the simplest and most common form of business structure. A sole proprietorship is owned and operated by a single individual who is fully responsible for the business's operations, profits, and liabilities. It requires minimal formalities and it is easy to set up. However, the owner has unlimited personal liability for the business's debts and obligations, meaning the business operates using the name of the sole owner, and if the business goes bankrupt, the owner must pay all the obligations of the business from his personal money. Some of the most common businesses that operate as sole proprietorships are retail stores, restaurants, repair and maintenance services, consulting firms, real estate agents, farming, agriculture, small home-based businesses, and online retailers. Partnership. A partnership is a business structure where two or more individuals or entities agree to share the profits and losses of a business. There are two main types of partnerships in the Philippines: general partnerships and limited partnerships. General partners have unlimited liability, while limited partners' liability is restricted to their investment in the business. Corporation. A corporation is a legal or juridical entity that is separate from its owners or shareholders, meaning the law identifies the business separate from its individual owners. It can sue, it can be sued. It has its own legal rights and obligations and is the most common choice for larger businesses. Shareholders have limited liability, which means their personal assets are generally protected from the company's debts. Setting up a corporation involves more complex legal and regulatory requirements, including registration with the Securities and Exchange Commission. The biggest corporations in the Philippines as of 2023 include SM Investments, SM Prime Holdings, BDO, BPI, Ayala Land, Ayala Corporation, and JG Summit. Cooperative. Cooperatives are formed by individuals with common economic, social, and cultural needs. They are owned and democratically controlled by their members, who share in the decision making and profits. Cooperatives are often used in agriculture and other community based businesses. One person corporation. This is a relatively new business structure in the Philippines, designed for single individuals who want the benefits of a corporation but do not want to establish a full fledged company. An OPC allows for limited liability, like a traditional corporation. Representative office. Foreign companies can also set up representative offices in the Philippines for limited purposes such as market research and liaison activities. A representative office is foreign corporation organized and existing under foreign laws, but physically located in the Philippines. It does not derive income from the host country and is fully subsidized by its head office. The representative office in the Philippines deals directly with clients of the parent company and undertakes such activities as information dissemination, product promotion for client companies, as well as quality control on products that are exported to other countries. The representative office is not allowed to offer its services to third parties. It is not subject to income tax since it is not allowed to generate any income from the services that it offers in the Philippines. The representative office is also ineligible for Philippine Economic Zone Authority or PEZA and Board of Investments registration. Branch office. Foreign companies can establish a branch office in the Philippines, which is treated as an extension of the parent company. A branch office can engage in commercial activities in the Philippines, but it is subject to certain restrictions and reporting requirements. In organizing a business, the owner or owners must decide what type of businesses are they forming. They must determine the size of the company so as to have a commensurate source of financing. Financing can come from the owners or shareholders, both in the form of a direct cash investment to buy shares of stock representing ownership of the business, and through the shareholders allowing past profits, which belong to them, to be reinvested in the business. Finance can also come from lenders, such as banks, as well as through suppliers providing goods and services on credit. In larger companies, the owners, called the shareholders, are usually not involved in the daily operations of the business. Instead, they appoint a board of directors to manage the business on their behalf. The board is charged with three major tasks: setting the overall direction of the business, monitoring and controlling the activities of the business, and communicating with shareholders and others connected with the business. Each board has a chairperson, elected by the directors, who is responsible for the smooth running of the board. In addition, each board has a chief executive officer who is responsible for running the business on a day-to-day basis. Occasionally, the roles of chairman and CEO are combined, although it is usually considered to be good practice to separate them and so to prevent a single individual having excessive power. The board of directors represents the most senior level of management. Below this level, managers are employed, with each manager being given the responsibility for a particular part of the business operations. The operations of a business may be divided for managerial purposes in different ways. For smaller businesses offering a single product or service, separate departments are often created. Tasks are grouped according to functions such as marketing, human resources, and finance, with each department responsible for a particular function. The managers of each department will then be accountable to the board of directors. In some cases, a departmental manager may also be a board member. Departments based around functions allow for greater specialization, which, in turn, can promote greater efficiency. The departmental structure, however, can sometimes become too rigid. This can result in poor communication between departments and perhaps a lack of responsiveness to changing market conditions. The structure shown on the screen may be adapted according to the particular needs of the business. Where, for example, a business has few employees, the human resources function may not form a separate department but rather form part of another department. For large businesses that have a diverse geographical spread and or a wide product range, the simple departmental structure can be modified as shown. Separate divisions are often created for each geographical area and or major product group. Each division will be managed separately and will usually enjoy a degree of autonomy. This can result in much greater responsiveness to changing market conditions. Within each division, however, departments are often created and organized along functional lines. Certain functions providing support across the various divisions, such as human resources, may be undertaken at head office to avoid duplication. Managers of each division will be accountable to the board of directors in some cases. Individual board members may also be divisional managers. Once a particular divisional structure has been established, it need not be permanent. Successful businesses are likely to be innovative and constantly seeking to improve their operations. This may well extend to revising their divisional structure. Take, for example, the business whose structure is depicted as shown. At some stage, senior management may conclude that the needs of customers and or operational efficiency would be better served by having a structure that was based on product lines rather than on geography. This may result in reorganizing so that there is a separate division for each product irrespective of where production takes place or where customers are based. Over the past decades, the environment in which businesses operate has become increasingly turbulent and competitive. Various reasons have been identified to explain these changes, including the increasing sophistication of customers, the development of global economy where international borders have become less important, rapid changes in technology, the deregulation of domestic markets such as electricity, water and gas, and increasing pressure from owners. The effect of these environmental changes has been to make the role of managers more complex and demanding. This, along with the increasing size of many businesses, has led managers to search for new ways to manage their businesses. One important tool that has been developed in response to managers' needs is strategic management. This is concerned with establishing the long term direction of the business. It involves setting long term goals and then ensuring that they are implemented effectively. To enable the business to develop a competitive edge, strategic management focuses on doing things differently rather than simply doing things better. Strategic management aims to provide a business a clear sense of purpose along with a series of steps to achieve that purpose. The steps taken should link the internal resources of the business to the external environment of competitors, suppliers, customers, and so on. This must be done in such a way that any business strength, such as having a skilled workforce, are exploited and any weakness, such as being short of investment finance, are not exposed. To achieve this requires the development of strategies and plans that take account for the business strengths and weaknesses, as well as the opportunities offered and the threats posed by the external environment. Access to a new expanding market is an example of an opportunity. The decision of a major competitor to reduce prices is an example of a threat. The strategic management process can be approached in different ways, and one of them involves these five steps. The first step is to establish the mission of a business, which may be set out in the form of a mission statement. This is a concise declaration of the overriding purpose of the business. It addresses the question, what business are we in? To answer these questions, managers should focus on those customer needs that the business seeks to satisfy rather than on the products currently produced. Thus, a publisher of novels might, for example, conclude that it is really in the entertainment business. The vision statement is closely connected to the mission statement and declares the business aspirations. It addresses the question, what do we want to achieve? Once again, it should be in as concise form as possible. Answering both questions, managers should be provided with a clear focus for decision making. Can you think why mission statements and vision statements should be concise? Well, having to produce concise statements compels managers to think carefully about the essential nature of their business and the aspirations that they have for it. In practice, this can prove more difficult than it may sound. Concise statements have the added advantages that they are easier to remember and to communicate to employees, owners, and others. Having established the purpose and aspirations of the business, objectives must then be developed to translate this into specific commitments for the forthcoming period. Objectives are designed to introduce real discipline into strategy process. They should provide clear targets or outcomes which are both challenging and achievable and which can provide a basis for assessing actual performance. Quantifiable objectives provide the clearest targets. However, some areas of performance, such as employee satisfaction, may only be capable of partial quantification. Other areas, such as business ethics, may be impossible to quantify. Next, undertake a position analysis. With the position analysis, the business seeks to discover how, given its attributes, it is placed in relation to its environment: customers, competitors, suppliers, technology, the economy, political climate, and so on. This will be done in the context of its mission and vision and objectives. This is often approached within the framework of an analysis of the business strengths, weaknesses, opportunities, and threats, a SWOT analysis. A SWOT analysis involves identifying the business strengths and weaknesses, as well as the opportunities and threats posed by the world outside the business. Strengths and weaknesses are internal factors that are attributes of the business, whereas opportunities and threats are factors expected to be present in the environment in which the business operates. The SWOT framework is not the only possible approach to undertaking a position analysis, but it seems to be a very popular one. Next, identify and assess the strategic options. This involves attempting to identify possible courses of action. Each of those identified should enable the business to reach its objectives by using its strengths to exploit opportunities while not exposing its weaknesses to threats. The strengths, weaknesses, opportunities, and threats are, of course, those identified by the SWOT analysis. Having identified the available options, each will then be assessed according to agreed criteria. Number 4, select strategic options and formulate plans. The business will select what appears to be the best of the courses of action or strategies identified in step 3 available. When doing this, the potential for selected strategies to achieve the mission, vision, and objectives must be the key criterion. While the strategies selected provide a general roadmap, a more detailed plan is required to specify the particular actions to be taken. This overall plan will normally be broken down into series of plans, one for each aspect of the business. In an effort to match the chosen strategies with the opportunities available, a business may decide to acquire other businesses. Finally, perform, review, and control. The business must implement the plans derived in step 4. The actual outcome will be monitored and compared with the plans to see whether things are progressing satisfactorily. Steps should be taken to exercise control where actual performance does not appear to be matching earlier planned performance. Now, what is the financial objective of a business? A business is normally created to enhance the wealth of its owners. Throughout this course, this discussion, we shall assume that this is the main objective of a business. This may come as a surprise as there are other objectives that a business may pursue that are related to the needs of others associated with the business. Can you think of two examples of what these objectives may be? For example, a business may seek to provide good working conditions for its employee, conserve the environment for local community, develop safer products for its customers, and offer fair trading terms to suppliers in underdeveloped countries. You may have thought of other objectives. While businesses may pursue these objectives, it is normally set up primarily with a view to increasing the wealth of its owners. In practice, the behavior of businesses over time appears to be consistent with this objective. Within a market economy, there are strong competitive forces at work that ensure that failure to enhance owners' wealth will not be tolerated for long. Competition for the funds provided by the owners and competition for managers' jobs will normally mean that the owner's interests will prevail. If the managers do not provide the expected increase in ownership wealth, the owners have the power to replace the existing management team with a new team that is more responsive to owners' needs. Does this mean that the needs of the other groups associated with the business, such as employees, customers, suppliers, the community, and so on, are not really important? The answer to this question is almost certainly no, if the business wishes to survive and prosper over the long term. Satisfying the needs of the other groups is usually consistent with increasing the wealth of the owners over the long term. Disaffected customers, for example, may turn to another supplier, resulting in a loss of shareholder wealth for the original supplier. A dissatisfied workforce may result in low productivity, strikes, and so forth, which will in turn have an adverse effect on owners' wealth. Similarly, a business that upsets the local community by unacceptable behavior, such as polluting the environment, may attract bad publicity, resulting in a loss of customers and heavy fines. The following example convey how two businesses responded to potentially damaging allegations. US clothing and sportswear manufacturers Gap and Nike have many of their clothes produced in Asia where labor tends to be cheap. However, some of the contractors that produce clothes on behalf of the two companies have been accused of unacceptable practices. Campaigners visited the factories and came up with damaging allegations. The factories were employing minors, they said, and managers were harassing female employees. Nike and Gap reacted by allowing independent inspectors into the factories. They promised to ensure their contractors obeyed minimum standards of employment. Early in 2005, early in 2005, Nike took the extra Early in 2005, Nike took the extraordinary step of publishing the names and addresses of all its contractors' factories on the internet. The company said it could not be sure all the abuse had stopped. It said that if campaigners visited its contractors' factories and found examples of the continued malpractice, it would take action. Nike and Gap said the approach made business sense. They needed society's approval if they were to prosper. Nike said it was concerned about the reaction of potential US recruits to the campaigners' allegations. They would not want to work for a company that was constantly in the news because of its allegedly cruel treatment to those who made its products. We should be clear that generating wealth for the owners is not the same as seeking to maximize the current year's profit. Wealth creation is concerned with the long term. It relates not only to this year's profit, but to that of future years as well. In short term, corners can be cut and risks taken that improve current profit at the expense of future profit. All decision making involves the future. Financial decision making is no exception. The only thing certain about the future, however, is that we cannot be sure what will happen. Things may not turn out as planned, and risk should be carefully considered when making financial decisions. As in other aspects of life, risk and return tend to be related. Evidence shows that returns relate to risk in something like the way shown on the screen. The relationship between risk and return has important implications for setting financial objectives for a business. The owners will require a minimum return to induce them to invest at all, but will require an additional return to compensate for taking risks. The higher the risk, the higher the required return. Managers must be aware of this and must strike the appropriate balance between risk and return when setting objectives and pursuing particular courses of action. Now, when we say risk, what is it? Business risks are uncertainties or potential events that could negatively impact a company's operations, financial health, or reputation. They can vary widely depending on the nature of the business, industry, and external factors. Here are some common examples of business risks: economic risk, market risk, financial risk, operational risk, compliance and legal risk, strategic risk, reputational risk, cybersecurity risk, natural disasters and environmental risk, political and geopolitical risk, supply chain risk, current currency exchange rate risk, interest rate risk, employee and talent risk, and technology risk. Managing these risks is essential for business sustainability. Companies often employ risk management strategies, which may include insurance, contingency planning, diversification, and compliance measures to mitigate the impact of potential threats and uncertainties. Now let me discuss about how management accounting is an information system. We have already seen that management accounting can be seen as the provision of a service to its clients, the managers. Another way of viewing management accounting is as part of the business total information system. Managers have to make decisions concerning the allocation of scarce economic resources. To ensure that these resources are efficiently allocated, managers often require economic information on which to base their decisions. It is the role of the management accounting system to provide that information. The management accounting information system has certain features that are common to all information systems within a business. These are identifying and capturing relevant information, in this case, economic information, recording the information collected in a systematic manner, analyzing and interpreting the information collected, and reporting the information in a manner that suits the needs of individual managers. The first two stages are concerned with preparation, whereas the last two stages are concerned with using the information collected. In our course, we shall be concerned primarily with the third element of the process, the analysis of management accounting information. We shall consider the way in which information is used by and is useful to managers rather than the way in which it is defined and recorded. Now, what kind of information do managers require? It is possible to identify four broad areas of decision making where management accounting information is required. Developing objectives and plans. We have seen that managers are responsible for establishing the objectives of the business and then developing appropriate strategies to achieve them. Management accounting information can help in developing objectives and in identifying the various strategies available. It can also generate financial plans to reveal likely outcomes from implementing the various strategies identified. These plans should help managers to evaluate each strategy and to select the most appropriate. Performance evaluation and control. Management accounting information can help in reviewing the performance of the business against agreed criteria. Controls need to be in place to try to ensure that actual performance conforms to the planned performance. Actual outcomes will, therefore, be compared with plans to see whether the performance is better or worse than expected. Where there is significant difference, some investigation should be carried out and corrective action taken where necessary. Allocating resources. Resources available to a business are limited, and it is the duty of managers to ensure that they are used as efficiently and effectively as possible. Management accounting information can play a key role in carrying out this duty. Thus, decisions such as optimum level of output, the appropriate location for production facilities, the optimum mix of products, and appropriate type of investment in new equipment tend to rely heavily on management accounting information. Determining costs and benefits. Many management decisions require knowledge of the costs and benefits of pursuing a particular course of action, such as providing a service, producing a new product, or closing down a department. The decision will involve weighing the costs against the benefits. The management accountant can help managers by providing the details of particular costs and benefits. In some cases, costs and benefits may be extremely difficult to quantify. However, some approximation is usually better than nothing at all. Adopting a more strategic and customer focused approach to running a business has highlighted the fact that many factors which are often critical to success cannot be measured in purely financial terms. Many businesses have developed key performance indicators or KPIs. These include the traditional financial measures such as return on capital employed, return on assets, return on investments, profitability ratios, and others. However, KPIs often include a significant proportion of non financial indicators to help assess the prospects of long term success. As the traditional provider of decision making information, the management accountant has increasingly shouldered responsibility for reporting non financial measures regarding the quality, product innovation, product cycle times, delivery times, and so on. It can be argued that non financial measures do not, strictly speaking, fall within the scope of accounting information and therefore could or should be provided by others. However, while it is true that others could collect this kind of information, management accountants are major information providers to managers and usually see it as their role to provide a broad range of information for decision making. The boundaries of accounting are not fixed, and it is possible to argue that management accountants should collect this kind of information as it is often linked inextricably to financial outcomes. They may, therefore, be best placed to explain the relationship between financial and non financial results. Imagine that you are the chief executive officer of the Philippine Airlines. What kind of non financial information may be relevant to help you evaluate the performance of the business for a particular period? Here are some possibilities: volume of passengers transported to various destinations, average load factor, that is the percentage of total passenger seats occupied per trip, market share of air passenger travel, number of new routes established by the airline, percentage of total passenger volume generated by these new routes, aircraft turnaround times at airports, punctuality of flights, level of aircraft utilization, levels of aircraft utilization, number of flight cancellations, percentage of baggage losses, levels of customer satisfaction, levels of employee satisfaction, percentage of bookings made over the internet, and maintenance hours per aircraft. We have seen that management accounting information is provided to improve the quality of managers' decisions. In other words, it is intended to have an effect on the behavior of managers. It aims to influence their actions and those of other employees in such a way as to contribute more fully towards achieving the business objectives. In some cases, however, the change in behavior caused by management accounting may not be beneficial. One potential problem is that managers and employees will focus their attention and efforts on those aspects of the business that are being measured and will ignore other aspects. Often, the aspects being measured are those that are used to evaluate performance. Managers and employees may therefore conclude that the things that count are the things that get counted. Such a narrow focus, however, can have undesirable consequences for the business. For example, a departmental manager has been given responsibility for controlling departmental costs, and this forms an important part of her annual performance appraisal. The manager is allocated an amount of money to spend on staff training each year. How might the manager's focus on the things that get counted result in undesirable consequences? To demonstrate cost consequences, the manager may underspend during the year by cutting back on staff training. Although this may help to exert control over costs, staff morale and longer term profitability may be adversely affected. These adverse effects may go unrecognized, at least in the short term, as cost control will be the focus of attention. There is also a potential problem that a particular measure will be manipulated, where, for example, profit is seen as important. A manager may attempt to boost this measure by continuing to use old, fully depreciated pieces of equipment in order to keep depreciation charges low. This may be done despite the fact that the purchase of new equipment would produce higher quality products and would help the business to flourish over the longer term. The incentive for such behavior is often linked to managers' rewards. Thus, in the case just described, annual profit related bonuses may be the key motivation behind the manager's actions. A further potential problem is that the targets against which performance is measured become the objects of manipulation. A sales manager, for example, may provide a deliberately low forecast of the size of the potential market for the next period if it is believed that this forecast will form the basis of future sales targets. The incentive to do this may again be related to management rewards. For example, where bonuses are given for exceeding sales targets. It may, however, be done to ensure that future sales targets can be achieved with relatively little effort. The management accountant must be aware of the impact of accounting measures of performance on human behavior. When designing accounting measures, it is important to try to ensure that all key aspects of performance are taken into account even though certain aspects may be difficult to measure. Furthermore, when operating an accounting measurement system, the management accountant must be alert to behavior aimed at manipulating particular measures rather than achieving the goals to which they relate. How about for not for profit organizations? There are many organizations that do not exist mainly for the pursuit of profit yet produce management accounting information for decision making purposes. Examples of such organizations include charities, clubs and associations, universities, national and local government authorities, churches, and trade unions. Managers need accounting information about these types of organizations to help them to make decisions. In essence, the nature and scope of management accounting information used by private sector, profit seeking businesses is must the same as is needed by not for profit bodies. This means that the principles of management accounting apply equally well to the non profit seeking sector. Not for profit organizations are not exempt from the changes that have taken place in the world. They too must be customer oriented and are under increasing pressure to deliver value for money in the manner in which they operate. This means allocating scarce resources carefully and monitoring fundraising activities closely. To operate in this environment, management accountants will often need excellent communication skills as levels of financial awareness among trustees and managers tend to be lower than in the private business sector. So there, congratulations for finishing this lecture about business organizations.